Michael Saylor just killed the dollar. Here's how. My name is Aiden Gillespie, and today I will be discussing Strategy's newest product, Stretch, and how it outcompetes with US Treasuries and how it's going to suck money straight from the dollar and bring it straight into Bitcoin. As always, none of this information is financial advice. Let's get started with how Strategy will destroy the dollar. First, we must understand what the value of the dollar is dependent on. So the value of the dollar can be dependent on the supply, how much money is being printed, and also the demand, how much foreign nations and individuals are willing to put into US Treasuries. With Strategy's newest product, Stretch, I believe it will suck a whole bunch of demand out of the dollar, out of these US Treasuries that are already spiraling out of control, bring it straight into Bitcoin and Bitcoin Treasuries. Let's take a look at the already demand crisis for the US dollar and how it's kind of spiraling out of control, and then how strategy will suck this and just create an exponential flywheel to create an extreme demand crisis for the US dollar. So, the selling of US Treasuries essentially devalues the bonds, which leads to higher rates. These higher rates lead to an increased cost of US debt, which means the debt is becoming more expensive because the interest rates to pay off that debt is higher. So they must do one of two things. Either A, they can print more money to pay off the greater cost of debt, but that's going to devalue the dollar, lessening the demand for these US Treasuries, which will just increase rates again, making the cost of US debt become more expensive again, requiring them to print more money. And this just creates a diminishing cycle that lowers the demand and causes more supply of the dollar, devaluing the currency. Another option they have is to cut rates. By cutting rates, that would artificially lower the interest rates that bondholders receive from holding bonds. So then the risk becomes greater because eventually that leads to inflation. And then the reward becomes smaller because now they're receiving less interest on the bonds that they're holding. So then bondholders would want to sell US Treasuries, which again leads to higher rates and increases the cost of US debt, causing either more money printing or more rate cuts. So either way, both of these are just leading to a cycle that is just exponentially decaying the value of the dollar. So the US dollar is in an absolute crisis already, and strategy is just going to suck the demand straight out of this here. So let's take a look at Stretch's structure, how it is so much better than US Treasuries. So Stretch targets a 9% annual interest paid monthly on a stabilized share price of $100. Now that share price can fluctuate a little bit, but here's what happens to help control that share price if it gets too high or too low. So first, if the share price gets too high, they can use at the market or ATM offerings to lower the price back down. With those ATM offerings, they're essentially issuing Stretch when it's trading at these higher prices of $101 or more. By doing that, they strategy receives or raises over $100 issuing Stretch, from issuing a share of Stretch, and only needs to pay back $9 each year. So it's a way for strategy to raise a lot of capital without really needing to pay that capital back all that quickly. Now, if the share price gets too low, what happens is that Stretch can stop those ATM offerings, and then they can use the capital raised from those ATM offerings to raise rates back up and push the price back up. So with these ATM offerings, it's essentially giving strategy capital to A, buy Bitcoin, and then B, to just have more capital if they need to raise these rates back up and raise that price back up. So now let's take a side-by-side comparison between Stretch and US Treasuries on their mechanisms for what they can do to adjust interest rates. So what happens when interest rates increase and you must lower rates? Well, Stretch can sell Stretch through the ATM. And how this affects investors is A, it controls the adjustment back down to that 9% yield. And then two, since Stretch is at a higher price, selling shares through the ATM raises more capital to buy Bitcoin. The purchase of Bitcoin leads to increased Bitcoin rating or how much their product is being backed by Bitcoin, which increases the investor trust, increasing demand into that product, which allows a flywheel to occur for their ATM to just continuously be raising more and more money to buy more Bitcoin, increasing their Bitcoin holdings, increasing their Bitcoin rating, and continuously increasing the investor trust and increasing that demand for their product. Now let's take a look at US Treasuries strategy for lowering rates as interest rates are increasing. What can they do for this scenario? Well, A, they can cut rates or inflate the currency. We already mentioned this briefly earlier on. If you cut rates, you get a smaller reward with a greater risk for these investors. If you inflate the currency, it's going to lower the demand for the dollar, which forces rates back up, which means the cost of debt increases, forcing further inflation and rates to continue rising until eventually the rates must be cut. So either of these options are just going to devalue the currency, whereas the options for Stretch is just going to add more value to Stretch to the product and add more value to strategy in and of itself. Now let's take a look with the opposite scenario where interest rates decrease and you must raise rates. So Stretch, since they want to keep their share price relatively stable, they can artificially raise rates from money raised through the ATM offerings. And how does this affect investors? Well, it helps minimize that volatility. It increases the demand back up, which allows that ATM flywheel to reset. On the contrary, it does lower the capital pool a bit and capital to buy Bitcoin in the future. However, by increasing that demand back up, allowing that ATM flywheel to reset, they're able to still eventually acquire more capital through that ATM and still buy more Bitcoin. So regardless, I think this is a very good strategy to use. And then let's take a look at the US Treasury strategies for raising rates. They don't often raise rates. They are far more likely to lower rates than to raise rates. But if they were to raise rates, here's how they can do it. They can artificially raise rates with open market operations. So with that, the Fed sells treasuries as the banks are giving up cash to buy treasuries. What happens then is that the banks then have less cash reserves, which are going to force rates up. So this keeps inflation down temporarily, but it does increase government cost of debt because those rates are higher. So then they have more interest payments on the debt that they owe. So then the government's either forced to cut spending or to print money to pay this higher cost of debt. They're probably not going to cut spending. At the end of the day, what's going to happen is inflation goes up anyways. It devalues the currency and eventually forces rates to get cut anyways. On top of that, it also risks banks from collapsing because now they have less capital in their treasuries in case people need more money, need to withdraw money, or need to take out loans. So, what method is better? I would say Stretch has a much greater effect on its investors than US Treasuries for both raising rates and lowering rates. So let's take a look at these key differences between Stretch and US Treasuries. Stretch pays investors higher interest rates. US Treasuries pays investors lower interest rates. Stretch is backed by Bitcoin. US Treasuries are backed by debt. Stretch raises rates when interest rates are low. US Treasuries cut rates when interest rates are high. Stretch is trapped in an asset flywheel in which they purchase Bitcoin, which increases their Bitcoin rating, increasing the investor trust in Stretch. So then Stretch price increases beyond their target yield price. So then they can use the ATM and issue Stretch at higher prices. So then the profits from selling Stretch at a price that's higher than their target price can be used to buy Bitcoin. And then they also have capital that was raised from these ATM issuances to be able to raise rates back up if rates were to get lower for the product. On the contrary, US Treasuries are not trapped in an asset flywheel, they're trapped in a debt flywheel, in which they cut rates and print money, which increases their cost of debt, forcing them to cut rates more and to print more money, which again just increases their cost of debt. So what is better? What should investors invest in? Well, personally, I like this. I would much rather have something backed by Bitcoin than backed by debt. I'd much rather have something that pays me more interest, and much rather have something that's buying more assets over time rather than being trapped in a whole debt flywheel. I think Stretch is far better than US Treasuries. I think Stretch is going to take a lot of demand out of US Treasuries and bring it straight into their own product and bring it straight into the other perpetual preferreds that they offer as well. So, what happens when money leaves US or other government treasuries for Bitcoin treasuries? Now, remember, Strategy is not the only one that will be able to do this in the future. Metaplanet recently made an announcement on perpetual preferreds. I'll make a video on that on a later date here coming shortly. But regardless, lots of Bitcoin treasury companies are trying to get this ATM started, trying to get these perpetual preferreds up and running. So what's going to happen to all this money as money's leaving US and government treasuries for Bitcoin treasuries? Well, less cash in the less capital in these treasuries, in these US and government treasuries, is going to lower the demand for treasuries, which forces rates up, increasing the cost of debt, forcing printing, and lowering demand for the dollar while inflating the currency. We have gone over this so many times. Governments, the US government, and governments all over the world are in a downward spiral where their debt is just spiraling out of control and there's nothing they can do to stop it. And all this is going to do is take demand away from these treasuries, bring it into these high quality Bitcoin treasuries, lowering the demand and increasing the debt and devaluing the currency of fiat while bringing money into Bitcoin. Now, regardless of what happens to Bitcoin, as fiat is being lowered and lowered in price from this lower demand and from this increased debt and devaluation in the currency, Bitcoin is priced in dollar terms or fiat terms if it's in another currency. So Bitcoin's price relative to the dollar, relative to fiat, is going to go up as long as fiat goes down. And then on top of that, as capital enters Bitcoin treasuries, ATMs can raise money to buy more Bitcoin. So then Bitcoin's price is going to go up. So in conclusion, fiat is already spiraling to its debt. Bitcoin treasuries are spiraling into the future. Bitcoin treasuries are going to suck capital straight from fiat and into Bitcoin. Michael Saylor has led the way. Others will follow. Bitcoin's our only hope. Fiat is dead. Thank you so much for watching. If you like this video, if you like the content I've been putting out, please consider liking and subscribing to support my work and to support my channel.